There's one question on everyone's mind, and that's, is this stock market going to crash? Are we in a monster bubble like we saw around the year 2000? Well, when you look around, even if you're an AI bull, you see a bit of madness. Billions of dollars flying around, IPOs soaring in hours, millionaires being minted every day. Maybe you've been one of them, but clearly this sounds a little bit like the dot-com bubble in the late 2000s. Everybody's saying that. But is it actually the same? So if you stick with me for a few minutes, I'll review the history and the evidence, and I'll show you whether this is a repeat of the dot-com bubble or not. And I'll also talk about 3 stocks you need to watch to see when and if this bubble is popping. So our minds play tricks on us. Oftentimes when we think back, our memories are muted. We remember things like fear and stress and pain, but the full emotion and vividness of the memories are toned down. And since your money carries so much emotion with it, this applies to your experience investing as well. So let me tell you what I mean. Everybody remembers the 2008 global financial crisis, and they recall that it was a bad time for markets. But I was working in this business through the financial crisis. I remember navigating it, and I've gone back and studied it in retrospect. And what people seem to forget, that it wasn't just scary then, it was terrifying. We really did not know day to day if the banking system or the economy would continue to function. People just forget how bad it was. Now, the dot-com bubble is the same thing, but in reverse. In this case, people forget how crazy it was. So yes, today the market is in rip higher bull mode, right? This week, AMD jumped 24% in a day on an announced partnership with OpenAI. That was good for an extra $78 billion in market value. Elon Musk's XAI just collected another $20 billion investment, even though it burns through $1 billion per month, right? The S&P is up about 15% year to date, setting new highs. The tech-heavy NASDAQ is up around 20%. So yes, this feels crazy, but it isn't crazy just yet. The dot-com bubble was much, much crazier. Silicon Valley was awash in investor money. There was lavish parties, absurd corporate headquarters with ping pong tables, and there were Super Bowl ads. And of course, those companies had nothing close to a profit to show. The mood in Silicon Valley and the spending was completely insane. So let's also look at the evidence in financial markets. But before I do that, let me take a moment to remind you that Stansberry Research is working at the cutting edge of using AI to create profits for everyday people like you with stocks. In our case, we just launched a fully quantitative system to select the best businesses in the market and combine them into an AI-driven portfolio that anybody can follow. It's built on the proven fundamentals of finance paired with AI. The back-tested results are incredible, beating the S&P 500, gold, a 60-40 portfolio, and even Warren Buffett's Berkshire Hathaway. You can learn all about it right now at stansberryaisystem.com. Go there right now. There's a link in the description. But let me get back to how markets stack up against the dot-com bubble. So yes, stocks are up. The modern bull run puts the NASDAQ 100 about 240% higher than its March 2020 low. But from 1995 through March 2000, the NASDAQ soared 1,080%. And yes, today, NVIDIA, Palantir, and others have posted huge returns this year, but the gains during the internet bubble were multiples larger. The shares of Qualcomm rocketed 2,600% in 1999 alone. In about a year, Amazon soared 1,600%. Now those are bubble gains. Okay, let's look at another sign of exuberance today. Initial public offerings, right? IPOs are ticking up, and the ones coming to market these days are soaring. You can look at Circle Internet Group. It's up 380%. CoreWeave's up 222%. But again, that's nothing compared to the internet bubble. The average one-day pop was 71% back then, and that includes rockets like the debut of VA Linux systems. That rose 700% in a day, and it had almost no business to speak of. And yes, we're seeing an uptick in the number of IPOs these days. This year, there's been nearly 70 IPOs with offerings above $5. In 1999, there were 470. So we're not there yet. And turning to valuation, you may have seen that some metrics like the price to sales ratio have hit all-time highs, but price to sales doesn't include profits. And businesses today are drastically more profitable than they were during the dot-com bubble. So if you look at how profitable they are, the forward price to earnings ratio on the S&P 500 is currently around 23, and that is high, but it's not yet at the dot-com bubble peak of 26. And in many ways, today's market feels like a frenzy, but feelings are unreliable. Yes, there's some froth, but we're still in the realm of rational for now. Now, I'm not saying that means the market must go up. We can see a correction or a crash. It's totally possible. But if your prediction is based on this being as crazy as the dot-com bubble, we simply aren't there yet. Our memories are imperfect, but a review of the facts shows that investors can go truly bonkers before eventually coming to their senses. Now, I'm sure you want to know, when will that happen? So let me tell you precisely what to watch. So number one, overall, I want you to keep an eye on corporate margins going into earnings season. High profit margins are holding this market up. If they start to turn, there could be trouble. Then I think you want to watch these three specific stocks that are pure plays on the AI boom. They've soared so far, and they are now priced for perfection. So when trouble comes, it'll show up in these three stocks first. So number one is CoreWeave. This is a pure play on cloud computing for AI. The company has $14 billion in debt and trades at 20 times revenue. So it's highly levered to the future of AI. Watch here for the first signs of trouble. Number two is Palantir. Palantir has become the play if you went to bet on the implementation of AI inside government and businesses. And it's seen as the leader here. And investors are in a frenzy. It trades now at 609 times earnings. Estimates anticipate revenue growth of 46% this year, so watch out for trouble if that falters. And number three is Oracle. Oracle's a big tech behemoth. It surged 30% in a day in September when it made a huge deal with OpenAI to provide AI computing power. But now this week, shares fell nearly 10% as the company reported its cloud business has lower margins as analysts expected. So if AI profitability struggles, you are going to see it here. So to talk more about how this market is different than the dot-com bubble, I brought in Stansberry Research's senior analyst, Alan Gula. Alan was at Goldman Sachs and Barclays Capital. He's a chartered financial analyst, and he's responsible for much of the fantastic investment track record of Stansberry's investment advisory. So, Alan, thank you for coming. I want to test your memory first. You were on a trading desk back in 2008 during the great financial crisis. Do people forget how scary that really was?
Yeah, well, in general, I do think most people remember that it was scary because there was so much economic hardships that touched people's lives. But yeah, in terms of the financial markets, people probably forget the sheer panic that ensued when Lehman Brothers filed for bankruptcy. I remember in early September 2008, Lehman stock had been decimated. But the company's bonds were actually sort of hanging in there. And you have to keep in mind that the Lehman still had a single A credit rating. So it's, which is a solid investment grade rating. So on Friday, September 12th, the company was rated single A. And then on Monday, the 15th, 3 days later, it filed for bankruptcy. And I saw some of those Lehman bonds trade down to 30 cents on the dollar in a single day. And then Goldman and Morgan Stanley were next in the crosshairs. Morgan Stanley stock fell more than 50% in a few days. And then Washington Mutual failed the following week. So it was just a string of dominoes. And so, yeah, the apex of the financial crisis and that run on the banking system was terrifying, as you said.
Yeah, people remember the recession, but they forget how scary that financial panic was. That's a good separation there. So, Alan wrote a piece on this topic about the dot-com bubble at Stansberry Stock Market Trends. And Alan, I consider you a great mythbuster of market narratives, right? Whenever something is accepted as common wisdom, you pull out all the evidence to prove them wrong or show them what they're missing. So what was it that made you stop and say, hold on, everybody's saying this is like the dot-com bubble, but it's not even close yet?
Yeah, I've seen a lot of headlines in the financial media talking about the so-called record valuations, and I do take issue with that. And then there's social media. So there are just so many people on social media who are reacting to every AI deal that's announced, and also the crazy moves in meme stocks and saying, oh, look at this. This is crazier than the dot-com bubble ever got. And it's just not true. I think a historical perspective is important. And what happened in late 1999 and early 2000 was it was a proper mania. Back then, people completely lost their minds. And that was sort of my motivation for writing the article, to sort of do that justice. And I wanted to look at the data, not just recount individual events like Pets.com going public and then declaring bankruptcy, but really look at the data. And some of the data is close. For example, if we look at the PE ratios, price to earnings ratios of the top 10 stocks in the S&P 500 now versus then, those top 10 stocks were more expensive during the dot-com bubble, but it's relatively close. And then there's other dimensions that I looked at that, like the NASDAQ 100 PE ratio, price, and it shows that the dot-com bubble was just a completely different animal, just another realm of craziness with a PE ratio approaching 100. So.
Yeah, and Alan, you and I have worked together for over a decade, and we're about the same age. And I think that great financial crisis taught us that you need to know this history. You need to go back and learn the history before you were an investor so that you know how to apply things today. So I was watching the markets a little bit during .com, but I didn't really invest through it. But going back to study it shows you so much that you need to know. And these facts and figures and stories, it all helps. But I think the clearest proof that you put together, Alan, comes from this simple chart. And you use a chart like this all the time. I see you share it at work frequently. Can you walk us through what an investor can take from this?
Right. So this is the chart of the NASDAQ 100 index, the top 100 stocks on the NASDAQ exchange, excluding financials. And this is just the price level on a log scale. So you could see the trend better. And the mania in 1999 to 2000 is really apparent on this chart. And you could see when the index first reaches that upper green line, the top of the channel, that was actually December 1998. So the NASDAQ 100 rose another 180% from there in the next 15 months. And so that's a blow off top. We haven't seen anything remotely like that since. Now, to be clear, a blow off top doesn't have to occur. Also, we could have another bear market or a severe correction before a blow off top and the eventual peak of the dot-com bubble.
Yeah. So what this chart does, any chart over a long period sort of has that same big swooping exponential rise, but this is a log chart, so that turns that into a straight line, and you can see that huge spike out of the normal rate of growth in 2000 was, it just stands out clear as day. And today we're a little overheated maybe, but it's nothing like that. And on the valuation measures on this market, no measure is perfect when you talk valuation. They all work in different conditions and different markets. But is there one you would turn to try and best diagnose this market?
Well, I focused on PE ratios in this article, but I do plan to do a follow-up article focusing on free cash flow and free cash flow yield. And free cash flow is really what's most important. It's the cash flows net of investment. And what's interesting is that Oracle now has a negative free cash flow. So the company is spending more on investment that it's bringing in operating cash flows. And that's something to keep an eye on. But when you look at the other big tech companies, their free cash flow is still positive, and their free cash flow yield valuations still suggest that we're not in a mania. They're not at the level attained during the peak of the dot-com bubble.
Yeah, so these companies are highly profitable on free cash flow, but this investment is dragging that down a bit. So I'm interested to see what the numbers show when you finish that up. But Alan, that's great. I think that's exactly what people need to know. This is a powerful bull market, but things have gotten crazier before. We'll keep you up to date on what happens next. And the newest update on our AI-driven portfolio was released to subscribers today. If you want to know how you can buy a portfolio of 20 AI-selected stocks and earn better, safer returns, just go to stansberryaisystem.com right now. The latest issue just hit inboxes. And as always, like and subscribe so you don't miss our next update. Alan, thank you for joining me, and I'll be back next week.